Hey everybody, it's Barron Shannon from alphatrends.net. Today's Friday, the 10th of August, 2018. We lost a little bit of ground in the broader market this week. The S&P down 18 basis points. Semiconductors got hit pretty hard, most of that here today. And it's kind of surprising that we still finished positive for the week on the NASDAQ 100. The Russell 2000 also outperformed a little bit. But again, the semiconductors, the Dow, all down a little bit. So we've had a good run here recently. And now we see that we're pulling back a little bit. The last 3 days, I had mentioned on Twitter, we were closing near the lows of the day. I guess I should have taken that a little bit more seriously because this gap lower might have been able to have been avoided, actually in the semiconductors for me. But the market did gap below this recent little band of what I thought was more of a correction through time. Ended up trapping people in here, and now we are below the 5-day moving average. So I think it makes sense that we become a little bit more defensive on the intermediate term. These are some of the volume weighted average price levels I've been pointing out recently. This is the where this rally began, and we had seen support from last month, and so this was our week to date volume weighted average price, which you can see we're well below. And it's interesting that, because that is obviously a 5-day volume weighted average price, that it's lower than the actual mathematical time-based 5-day moving average, meaning more volume came in on the downside than the mathematical average would indicate. Anyways, again, we gapped lower down through the volume weighted average price from the little shakeout at the beginning of the month. And now I think that in order for this market to become a little bit more neutral in the intermediate term, we're going to need to see it back above 284. So going into next week, we want to be a little bit defensive. It is good in that the volume weighted average price from this low, this high, and back from this gap all kind of came together in here today, and now that will be an important level. Today's low, that is, will be an important level next week that we want to see this market hold above. That's also approximately 50% retracement of the range that we've had so far in August. So from this 279 and change up to this peak, you can see here's the 38.2% retracement and the 50% right in here at that cluster of volume weighted average prices. So I think we just need to let this market settle down for a little bit. We've basically made it through earnings for the majority of the companies. We'll still see earnings trickle in for other companies in the next couple of weeks, but the majority of them have been reported, and we still have on the daily time frame a pattern of higher highs and higher lows. We still are unable to crack a new all-time high in the S&P 500. The Nasdaq had been unable also to show a new all-time high this week. It did have a nice run, as we know, from that rising 50-day moving average, and when we get down to a 30-minute time frame, you can see that this market is still holding above the volume weighted average price from that shakeout that we'd seen, and from this little low here at the end of last month. So a little bit more relative strength in the Nasdaq, which makes sense because this market was up on the week. But it seems as though it's getting maybe a little bit more tired up in here. You can see, and a lot of people will point out that the volume was diminishing on the rallies. That's not typically, that's not very unusual, but that does, give us reason for concern that maybe this market needs to flush lower a little bit, or perhaps spend some more time correcting. The Russell 2000 is still within a bigger, maybe an ascending triangle here. This trend line is something that is clearly important. You can see that we broke the 50-day moving average on that last test of the trend line, but again we bounced from there, and this area in here near about 166.5 is really the most important level intermediate term for the Russell 2000 to hold above. What you see though is, even on this rally of the last week and a half, it's been a pretty choppy stair step higher, but the fact is we do have higher highs and higher lows. So in the intermediate term, along with that rising 5-day moving average, we still look at the market as positive to maybe, digesting gains neutrally here a little bit. So this market also, as I mentioned, showing some relative strength. It was up the most basically of the equity indexes, up 0.75% this week. Semiconductors, as I mentioned, this one I kind of thought we were going to make a run for the top end of that trend line. At Alpha Trends, we had been long some, got out of partial, and unfortunately ripped the band-aid on the balance of it here today, just because there was too much damage done and didn't want to continue to hold it for new lows. Now, that's my time frame as an intermediate term swing trader. If you're a longer term trader, you might be looking at something like the year to date volume weighted average price, which is above the 200-day moving average, and this trend line that's creating a broader symmetrical triangle. So realistically, the range is tightening in the semiconductors as we see, these peaks are coming in at lower prices, but the valleys are increasing as well. So I think that 104-ish is likely to be tested, and we'll see what happens if it gets down there, whether it can continue to hold or if we see some further breakdown from here. I certainly wouldn't suggest shorting if it got below there. I think that would be a kind of a sucker short, in that it's just come from 109.5 down to 104. Very similar to the sucker shorts that we've seen in the financials and we've talked about over and over again this year. The financials are still up at the top end of that range. They are above the year-to-date VWAP. I wouldn't be surprised to see them pull back further from here. I'm sorry, we're just closed below the year-to-date VWAP. That's right here. I was looking at the 200-day moving average. So, we failed at the top end of that range, and as I had mentioned to subscribers, buying a so-called breakout beyond this point was most likely going to turn into a sucker's bet, just as selling short on a breakdown. You have to ask yourself how much energy gets expended on the moves to that so-called breakdown point. How much energy was expended on the upside before it was able to push through there? This is not an educated purchase up in here, because you have to ask yourself, where has it come from? And it's just rallied from 26.25 to 28.5, so about 10%. Now we're seeing that this market is in need of further digestion. It wouldn't be a surprise to see it pull back down into towards that 50-day moving average. And the biotechs are behaving somewhat better in here. They were down for the week about 34 basis points, but they're holding at this, in this range. There's no reason to be a buyer until they take out some resistance, and this is what we were looking for, was a rally up, pull back, and then maybe get going. Instead, we saw it pulled back and continued to pull back. That's why I personally don't buy pullbacks, because you never know if it's the pullback that you have to worry about that continues to pull back further and further. I would rather wait for evidence that the buyers are regaining the strength in a market, and they don't seem to be in the biotechs, not on the intermediate term. So I think next week, going into next week, we have a lot of uncertainty, and it will be prudent to go slow overall.